Good evening, everyone. Thanks for joining us to this ArthSamvaad, our monthly commentary and your ultimate guide to navigating the world of personal finance. And this is our second edition in as many months. And last month we have witnessed a huge volatility and some world order changing policy decisions from the president of the US. Let's try to decipher through this call some of the aspects, taking help of our esteemed guest, Mr. Balaji. And coming to, let me give just a small brief of Balaji Vaidyanath. He's the director and CEO and CIO of NAFA Asset Management Company. He has experience of more than a decade in equity markets, first as a research analyst and then as a portfolio manager at Sundaram Asset Management. His track record as a fund manager for Sundaram Portfolio Managers for almost 7 years has been impressive across 6 diverse strategies. He has delivered consistent returns, performing the portfolio benchmarks by over 100% across strategies till December 2015, when he relinquished the charge. His ability to stay way ahead of the broad market in bearish phases is a key strength. And that's one of the reasons why we have invited him today to talk a little more in detail about it. And his conviction, lengthy holding period, low churn, and willingness to stay in cash are integral to his fund management style. With Vaidyanath, Mr. Vaidyanath as CEO and CIO of NAFA Asset Managers, offers prospective investors a platform that rests on a solid footing. So with that little introduction, I would hand over to Balaji. I'll just set the ground rules here. He would put across his thoughts on the market and the current happenings within his time frame. And then we have a set of questions based on that. And also we have some ready questions. Also, some of the questions we already started to receive from the clients and attendees. So that would be also be discussed. Thank you, Balaji. Please, it's your turn now.
Thank you so much, Naresh. Thanks to Team Velocity. It's a pleasure to be part of this ArthSamvaad second edition and to interact with your clients and prospects. It's always a pleasure. So like you set the context very rightly, I think definitely we are in challenging times in the sense that every cycle feels like that. Every cycle feels like an unknown where you feel like this is like something very unnerving and challenging. 2020 COVID was not very dissimilar in the sense that it was about the public health emergency and the whole world came to a grinding halt, including the air traffic and sea traffic and everything. And we all know what happened between March 2020 to June 2020. It was an unknown at that point in time. So one thing about the market, Naresh, is that if you closely observe the history, is that they never react twice for the same reason. What I'm trying to say is that in 2020, we had the first COVID issue that hit us. And subsequently also we had many variants of COVID. We had this Omicron scare and something like that. But markets basically shrugged it off after that first main event. The subsequent variants did not really kind of create the price damage which was caused during the first version of COVID. Similarly, we had the great financial crisis in 2008, where a lot of these, suboptimal, real estate products were put into exotic derivatives and sold on the premise that the US real estate market can never go down. And finally, the US real estate market turned, and that led to many financial institutions crumbling, including Bear Stearns and Lehman Brothers and all that. This happened in 2008, and then there was a significant bailout package announced by the Fed. Similarly, if you rewind back to March 2023, exactly 2 years back, we had this regional bank crisis. Silicon Valley Bank in the US had an issue. In fact, the iShare MSCI regional bank ETFs in the US, they crashed significantly. But if you look at the financial markets behavior world over, and even including US, you hardly had 1 or 2 days of fall, and it just kind of shrugged it off and moved on. This is the first time where we are seeing this tariff related issue. The second time impact is much more than the first time impact. So let me clarify this, right? So tariff as such is not an unknown. Okay, tariffs was something that was actually there in Trump 1.0. When he introduced under two sections in the US, 301 and 232 of the Trade Act, where he specifically imposed tariffs on steel and aluminum way back in 2018, around 15% for steel and 10% for aluminum or something like that. And under the Section 301 Act, there was a generalized 7.5% to 25% tariffs that was imposed on China. So if you recollect anecdotally also, many of us will have friends in the US, friends and relatives in the US. You will agree with me when I say that prior to 2020, generally phones, garments, sporting equipments, shoes, apparel, all these used to be 10-15% cheaper in US compared to India. So it would always make sense for your NRI relative or friend to take something from the US and bring it to India for you, because you can make that 15% kind of arbitrage. But even before Trump 2.0 came into the picture, the inflation shot up significantly to the point where the arbitrage was completely gone. Whether it is an iPhone or whether even it's a luxury watch, whether you believe it or not, the cheapest place in the world to buy a luxury watch is not Middle East or US, it's the India, actually. It's India as the cheapest place to buy a luxury watch at this point in time. So that arbitrage over a Nike shoe or a gear, sporting equipment, tennis racket, that arbitrage basically disappeared. In fact, in few of the things, US was more dearer than India. This was essentially a fallout of that 7.5 to 25% broad-based tariffs which Trump introduced during Trump 1.0. What was I won't say surprising, but this tariff element actually continued even during the Biden administration. It was not like as if Biden came into the picture and reversed the tariffs or anything of that sort. So that steel and aluminum tariff and generalized tariffs over China still continued to be there on various products. To that extent where initially when the tariffs were imposed, the US steel prices actually went up. And then subsequently, the prices actually came off, both the aluminum prices and the steel prices. So this wasn't, people wrongly attribute that inflation to the COVID impact, right? But the actual inflation was because of this tariffs which was announced during Trump 1.0 during the 2018 to 2020 phase, which was further accentuated during the COVID period. So now we have entered Trump 2.0. And, when you spoke to me last week and you mentioned about this ArthSamvaad event, and of course, I had some thoughts in my mind as to what to speak, but then I had to change those thoughts every 10 to 12 hours because, such was the magnitude and speed of the announcements that was happening globally in the markets that, it really didn't kind of make sense. So if America was actually listed company traded in the Indian stock market, SEBI would have put it in the ASM, GSM category. It was that kind of volatility that we witnessed in as far as the American markets are concerned, right? So we have had huge swings. One common pattern that used to be the case during the downfall is that there used to be a lot of globally, things used to be very correlated. You could find that those correlations were always there. So people used to say copper used to be referred as Dr. Copper. So when you want to know the pulse of the global economy, you look at the copper price. If the copper price was steady, you would say that global economy is still doing fine. When the copper is dropping, you say that global economy is kind of not doing great. So Dr. Copper, that is what it was called. Similarly, when the US markets correct significantly, you would also see the bond yields correcting, meaning that people will sell from the US equities and move to safe haven like bonds. So what happens is as they keep buying more and more bonds, the price of the bond moves up and the yield falls down. So the interest rates will also kind of come down, and there will be a bit of a movement towards a safe haven, and automatically you could see that the cycle will settle down, and then at some point in time, as the economy starts picking up, you will see that the interest rates start moving up. But this time around, it's just completely all over the place. You have Japanese bonds rising, you have the German bonds that are going down, you have Indian bonds that have actually corrected. And for the first time, maybe not the first time, but it's a big rare event that stock markets in US are correcting, but at the same time, the bond markets are also correcting. So from 3.9% 10-year, it has gone to almost 4.4 to 4.5%. So if you look at the 30-year bond, it seems like as if the Greek market is currently saying that the Greece 30-year bond is actually much safer than the US 30-year bond. That's what, coming from the PIGS crisis way back in 2010, when Portugal, Ireland, Italy, Greece, and Spain were considered to be the fragile European nations. Today, the bond market is saying that the Greek 30-year long-term bond is much more safer than the US 30-year long-term bond, right? So this is the kind of situation that we are grappling with. Gold is going like there is no tomorrow. Crude oil is saying something else, saying that there is going to be a complete a halt as far as global trade is concerned. So net, we have to see that the fact is, this is a self-inflicted wound. It's not a natural correction. GFC, there was a build-up over 6-7 years where those exotic products were sold, and a natural kind of thing that there was a boom cycle and then there was a bust cycle. COVID was a unknown. Once in 100 years you have these pandemics, and therefore again it was an unknown. Here the US economy was actually rocking. Your unemployment rate in the US was 3.5%, which was much below the comfort level of 5%. Your services PMI and manufacturing PMI were oscillating between 49 to 51, nothing alarming about it. US market was 65% of world GDP, and the per capita income of US moved from $65,000 during Trump 1.0 to $81,000 at this point in time. Even the poorest state in the US, Mississippi, has a per capita income of $40,000, which is much higher than most of the other countries. For perspective, India's per capita income is $2,500 to $2,600. So despite that, economics 101 says that if I'm a country, Naresh, if I'm abundant with capital, and you are a country, if you're abundant with labor, I export capital to you and you export labor to me. That is how both of us can actually kind of shine. That is exactly what was happening. But today, when I say that, no, I have capital, but I want labor also, that is a little unrealistic. I'll just give you a quick data point. The monthly manufacturing wage in the US for a typical semi-skilled person who is into the manufacturing industry is $5,800 per month. The monthly manufacturing wage. The same wage in China is $1,100 a month. And the same wage in India is something like $300 a month. So India's manufacturing wage is 3% of US's manufacturing wage. China's manufacturing wage is about 18% of US's manufacturing wage. So for the current Trump 2.0 regime to say that we can move back manufacturing, it's simply unrealistic. It's impossible. It is like Europe saying that we will rearm ourselves, and you can do all the rearming, but where are your soldiers? Are you going to put 50-year-old and 60-year-old in the battlefield to fight your enemies? You can rearm by machine and equipments, but what about your labor? Similarly, soldiers. Similarly, what about your labor? So what I think is going to happen is the fact that, like how you have these investment related summits that happen for every state every year. You have Vibrant Gujarat, you have Enchanting Tamil Nadu, and all these 2-3 day events where there lakhs and lakhs worth of crores of MOUs are signed, but in reality nothing really kind of happens, right? So only a trickle or a partial amount that actually gets executed. Similarly, you're going to see a situation where, in the name of optics and for pacifying, you're going to see many companies around the world and industries around the world announce a lot of investments. And these investments will typically be in process-driven industries. So for example, in benzene or something like that, where there is no labor requirement, everything is automated, without there's very, very minimal labor requirement. End-to-end automation is there. Maybe in a factory you might require some 50 people or 30 people. Those kind of investments, you're going to see a significant amount of those investments being announced as far as the US is concerned. But your regular labor intensive investments, it is simply impossible to kind of move that. And this is where I feel that we have an edge. Earlier the saying was that when the US sneezed, the world catches a cold. But today, when the US sneezes, it is not necessary for the world to capture a cold. That is what the bond market is indicating. So, at one point in time, the differential between the US 10-year yield and Indian 10-year yield used to be around 300 to 400 basis points. Today, the US 10-year yield is 445 and the Indian 10-year yield is 645. So there's only a 200 basis points difference between the both. And you have a significant amount of money sitting in the US Treasury market from all over the world, China, Japan, Europe. Europe has $11 trillion investments in the US. So at some point in time, people will start thinking of diversifying and moving assets and so on and so forth. And in this endeavor, of course, gold will obviously play a larger role, and we are already seeing the traction that is there in gold. But can we also see that positive rub-off impact from a country like India, where there is a huge demographics available, and median age population is still quite low, and we have already proven our efficient skill sets as far as the services industry is concerned. The answer is probably yes. So to be extremely bearish on India at this point in time, just because America is doing the self-inflicted thing, may not be the right answer, at this point in time. So you are seeing that globally, companies like, say, BYD, for example. Today, BYD's turnover is greater than Tesla, $105 billion. They've exceeded the turnover, and the cost of a BYD is probably, suppose if you were to buy a BYD in, say, Thailand, it's going to cost you just about $10,000. Vis-a-vis a Tesla, which is going to cost you about $22,000. So similarly, if you want to buy a BYD in Malaysia, it will be 50% cheaper than Tesla in all these countries also. So the point is that it is simply impossible for US to try and achieve their stated objective. There could be some optics, there could be some this pause was announced, and there's going to be some give and take, etc. So from India's exports point of view, I'm not really bullish. Even in a very free world, where we were in a globalized world, we did not really do much, as far as the exports are concerned. But we should and we must continue to be an inward-looking economy, where if you buy companies based on their domestic strength, then there is money to be made. That is how we are looking at this whole situation. And this current fall, of course, has taken the froth out of the market. So we have seen the price damage from September 2024 till April 2025. That's about 8 months of a price damage. Maybe you're going to see another 3-4 months of time damage. People kind of coming to terms with the new optics, new world order, etc. And then from there on, a bit of a base is formed, and from there on, we start moving higher. So mid caps, which were, as people say, were probably in the overvalued zone, have come to a bit of a fair valuation game. And similarly, in the small, it is very difficult to holistically say that, because mid cap index has about 150 stocks. So each and every stock should be seen in isolation, but somehow there is an obsession over the index P multiple. But just going by that, I'm saying that there has been a correction in the P multiples of Nifty, mid cap 150 and the small cap 250. And the playbook is exactly similar to 2018, where if you look at the calendar year 2018, the first 9 months of the calendar year, Nifty outperformed the mid cap and the small cap. In the last quarter, that is October, November, December of 2018, the mid caps and small caps started outperforming the Nifty. And then from calendar year 19, 20, 21, that 3-year period, and 19 to 23, that 5-year period, the mid caps and small caps gave far more greater returns than the Nifty, basically. So this overall thing of unorganized to organized, non-GST compliance to GST compliance, these things are kind of playing out in a lot of these mid-cap companies. So just to purely go by the semantics and say that something is a small cap, meaning it is risky, may not be the right thing to do. It might be a small cap by SEBI definition. So today we have a company like, say, Green Panel Industries. So this is the Asia's second largest manufacturer of MDF today, with 9 lakh cubic meters. They are the Asia's second largest MDF. So, but they will be classified as small cap because the market cap is around 3,600 crores. So, but these things have a significant potential to grow in the slightly medium to long-term perspective. And typically what we have seen is that headlines have shelf space, shelf life, basically. So whether it was COVID had maybe a 2-year shelf life. Russia-Ukraine war had a 12-month shelf life. Israel-Hamas attack during October 2023 had a 6 to 8-month shelf life. So maybe the tariffs will have a 1-year shelf life, right? So it's not like the issues get completely resolved or anything. Israel-Hamas is still not resolved. Your Russia-Ukraine is still not resolved, but markets have this ability to climb the wall of worries and move forward. So from that point of view, tariffs is not an unknown. And if anything, there is going to be some bit of advantage from an India point of view. Even before Trump 2.0, even before the Liberation Day tariffs were announced, we were seen as Bangladesh plus one, in the sense that there was a turmoil in Bangladesh, and therefore, textiles finally, so we could get some cheap cotton yarn from China and, shine as far as exports are concerned on the garment side. So these things can happen and spring a surprise. So like Ruchir Sharma says, Indian markets, it will surprise both the optimists and the pessimists. And it's a 2-step forward and a 1-step backward kind of an economy. And this time is going to be no different. So if someone were to have a 3-year view, 4-year view, etc., I'm quite constructive about the markets, considering the price damage that has already happened so far. So I think I've covered a lot of it. So I'll be happy to take any questions.
Yeah, thank you, Balaji. It's a pleasure, like always. I think the last time when we were, then I was hosting a physical panel, and you were there as one of the members, panelists, and I recollect vividly how well you, deconstructed the entire thesis. That half of our questions were addressed with your. In your narrative itself. Similarly, suddenly I realized some of the lists of questions were already addressed by you. And yeah, it's always pleasure to, listen to you with your clarity of thought and the thesis. Yeah, but still, yeah, there are certain things and certain aspects of which there are queries which I'll start. And I would request the attendees to also please use the chat box to ping in your questions. We would be discussing as and when we receive them. Yeah. So again, you did mention about the allocation to an extent, but I'm just again asking if from the what we have seen, the volatility and possible anticipation of volatility, what should one look at adjusting their portfolio allocations?
Between large, mid, and small, or how do you?
Yeah, to an extent. Also, we are thinking of if the extent of overweight or lower weight with equity also to an extent. I mean, because you did mention about gold parts and all, right? Yeah, it covers the multi-asset part. Yeah.
So the way I see it, I'm a big mid cap, small cap bull as far as India is concerned, right? So this has always been the case. So I would actually advise in my humble opinion, I would advise that if you want a safety net, don't look at large caps as a safety net, especially in India. So if you want safety net, you would rather go to gold. You have a mid cap, small cap exposure, and you go to gold, you can completely skip large caps. Because my view has always been that large caps in India are suffering extremely high amount of disruption. Very simple case in point. Usually, when the markets correct in India, the safest hiding place at some point used to be the FMCG companies.
Yes.
Okay, you go to Unilever or Dabur or Nestle or all these type of companies will fall less compared to the market, and these are all steady, linear companies, etc. But today, I can tell you that literally every sector in the large caps is facing unprecedented amount of disruption. I can quickly take you through these sectors, right? So take paints, for example. Paints used to be a four-player market: Asian, Berger, Kansai, Axo, and to some extent Indigo. It was a five-player market, and within the last three years, the number of market players have doubled with the entry of Birla, JSW, Astral, Pidilite, etc. And these are all serious players, right? Pidilite is on the lookout to buy Axo, and Birla has become the number two player as far as from the point of view of capacity. And when
Distribution.
I was in Ludhiana last year, 70% of the Asian Paint distributors have migrated to Birla Opus. So we have seen the correction happening in Asian Paints. Right, we had the biggest bull market between end of 2020 to end of 2024. In the 4 years time frame, Asian Paint had a significant time correction to the extent where their PE multiple contracted from 75 PE to now 48 or 45 PE multiple. So a significant correction happened. Similarly, if you look at FMCG, which is about a good 15% of index today, what is happening in FMCG is something that we all need to pay a lot of attention to, because FMCG was here till now. I wrote about this on Business Sign also, I think about 3-4 weeks back. I'll send it to you. The distribution setup was extremely fragmented. Okay, if I'm Britannia, I can simply bully you, Naresh. I can just come and tell you that, look, Naresh, you have to stock 100 kgs of my Good Day biscuits this week. So if you don't do it, I will remove Naresh and install Chaitanya. If Chaitanya doesn't do it, I'll remove Chaitanya and install Avinash. So my working capital was always on your balance sheet. Okay, if I'm an FMCG company, my working capital, my inventory was always on your balance sheet. So you had to put working capital as a distributor. And my vendor, which includes the maida guy and the sugar guy and the wheat guy and the milk guy, I used to pay them after 60 days or 70 days. So I was enjoying a negative working capital cycle for a long period of time. And this kind of, I don't know if it led to some kind of complacency. The ad spends have been very, very constant. They've not really invested in their brands so much. So what has happened now is that you have this disruption in the form of quick commerce. You have Blinkit, Instamart, Zepto, Flipkart Minutes, Reliance Stage, you name it, all these guys have come. And if Britannia is going to go and tell them that you have to stock 100 kgs of my Good Day biscuit in your dark store, they're going to say, no way. You come and give it to me when I need it. I'm not going to stock your working capital. So what happens to Britannia? I have to my inventory loads up. My logistics cost moves up, because whenever he asks me, I have to go and deliver it. And he will tell me that, look, if people open Blinkit, I have two choices. I can show Britannia Good Day biscuit, or Avinash has started. Avinash is a D2C company. He's only present on Instagram. He started Healthy Cookies, a new brand. So I can put his product also. So unless you pay me more, I'm going to promote Avinash's product. So when that happens, so you have to sell more on the advertising. So Hindustan Unilever is now working with almost 5,000 to 10,000 influencers. They were forced to buy a brand called Minimalist, 500 crore brand. They paid 3,000 crores price to sales. And we are still talking of a sector which in totality produces just 50,000 crores of profits. Today has a market cap of 25 lakh crores, which is 50p multiple. I'm talking about Unilever, ITC, Britannia, Nestle, Titan, Tata Consumer, maybe one more name. I'm in the Nifty 50 I'm talking. So the Asian Paint. So this is the problem with FMCG companies, 15% of the index. Then you move to IT, which is again another 15% of the index. So in IT, the problem is that we have all seen the TCS, which has come out with the numbers recently. They have hired just 625 people in Q4. The problem is that you have companies like Eli Lilly, Nike, Adidas, all of them coming to India and setting up their own GCCs, from as close as a 500 seater to as big as a 20,000 seater or whatever it is. Cognizant and Tech Mahindra and all these people are offering GCC consulting, advising their clients how to set up the GCC, how to operate, etc. So this was a job that was being done by the IT services companies. So now with the advent of artificial intelligence and chat GPT, etc., what is happening is bigger deals are getting renewed at a much slower, smaller number. At $1 billion deal, it gets renewed at a $600 million, because the client is saying that I don't need you to use 1,000 people for my project. Use 700 people and use chat GPT. Because you are using chat GPT, I will not pay you $30 an hour. I will pay you probably $18 an hour. So both volume and value is getting hit. So this 15% of the index is having this. So FMCG 15, IT 15, that is 30% of Nifty has this issue. Then you have auto, which is around 8% of the Nifty. In auto, you have to split it between four-wheelers and two-wheelers. Let us look at four-wheelers. In four-wheelers, you have Maruti, Mahindra, Tata Motors, and Hyundai, right? So the thing is that if you look at the auto numbers, Naresh, you can anecdotally also you can see in Hyderabad also that the growth in the four-wheeler space is coming from Kia, it is coming from Toyota, it is coming from BYD. Premium cars are doing well, etc. But whereas your Maruti, Hyundai, etc. are very sluggish in terms of volume growth. So growth in the auto four-wheeler space is happening, but the point is it's happening outside the listed space, not within the listed space. So what is the if Toyota is doing well, you're not going to be benefiting by having exposure to Maruti. Similarly, in the two-wheeler side, you had TVS, Eicher, Bajaj, Hero, four-player market. Today, I can give you 15 to 18 players in the two-wheeler market. You know, there is Greaves Cotton with his Ampere, there is Joy e-bike, there is Rattan India, Ultraviolet, Aether. So many guys are doing so many different things. CKD, somebody is manufacturing, somebody is assembling. So market does not really need to see market share erosion before the prices start coming down. Even if it perceives market share erosion, it is enough for the derating to happen. Asian Paint has strictly not still lost significant market share, but the perception that it will lose market share is enough for the market to punish the stock. So this is the problem with two-wheeler companies, and none of the names that I mentioned are in the Nifty. Everything is either outside Nifty or unlisted. So Greaves Cotton is outside Nifty. Aether is unlisted. Similarly, you know, we have covered FMCG, IT, auto, right? So this is basically about 37%. Then the biggest thing is banks and financial services, which is around 35% of the index weight. And today you are seeing that the non-lending financials are kind of, you split into two: lending financials and non-lending financials. The lending, so entire Nifty comprises only of lending financials except for two stocks, SBI Life and HDFC Life. So what is happening is lending financials have become commoditized. So when something becomes a commodity, the valuations are not very different from global valuations. Whether you manufacture steel in Orissa or London or Switzerland, the price to book is not significantly dissimilar. Similarly, lending, the questions we need to ask is, can these banks trade at such a premium to Wells Fargo, JP Morgan, Bank of America, and all these places? So HDFC Bank, if you remove the fee income component, that is the distribution of insurance, mutual funds, and all those things, if you remove that, in the core banking, they're not making money in the private sector banks, right? Yeah. So globally also, if you look at all the indices, as they have grown into developed market indices, the weight of financials has actually come down. And I don't think India will be any different. So this is around 35% of the index. So 70 to 75% of the index has these kind of issues. Then you have the Reliance, which is again in its petrochemical business seeing extreme amount of capacity addition by BPCL, HPCL, IOCL, Nayara, you name it. So which is why if you and one more interesting stat, YouTube. It's not like large caps are not doing well, Naresh. Large caps are doing well. Large caps that are not listed are doing extremely well. So you have the FANG companies, Microsoft, Apple, Netflix, Amazon. They're all growing very fast in India. But how by buying Nifty, you're not going to get their exposure. YouTube revenues in India is 15,000 crores. YouTube revenues. Okay, just the ad revenues and just the subscription revenues is 15,000 crores. For context, Z Entertainment is about 8,300 crores and Sun TV is about 4,300 crores. So Z plus Sun put together is not even matching YouTube revenues, basically. So if you need to get YouTube exposure, you need to buy a NASDAQ ETF. So the point is that early 2000, much of the growth was happening on the large cap side. You could just throw darts at large companies. Two-wheeler penetration was low, four-wheeler penetration was low, banking penetration was low. You buy large caps, you could make money. But mid and small caps are untouchables because of lack of corporate governance, promoter being bad, and now it's a complete reverse situation. Large caps are facing huge disruption, but there is a tremendous amount of opportunity available in the mid and small cap space, which is why that I tell my friends and clients that, look, if you want safety net, go to something like a gold or something and invest equity via mid and small caps.
Again, you have extinguished 3-4 questions. Thanks for that elaborative answer, Balaji. And so I mean, we had queries on, because I see the queries. So we had queries on technology, how it impacts sector. Yeah, okay. A little bit on your preferences towards sectors, if at all we want, or is it sector based? Because you did mention about formalization, you did mention about consumerism. So is that what I can capture, that your favorites, or is this something more which you feel that would do well?
Sure. So a couple of things, right? So what we do at NAFA is that we kind of track the consumer behavior changes, which happens every, 10 years or so. So in 2008, 3 out of 4 cars sold in India was hatchback, small cars. In 2024 or 25, 2 out of 3 cars sold in India is a SUV or a mini SUV. Income levels have gone up. So if you look at the per capita income of India, it's about $2,500, which is about 2.5 lakh rupees per month. Per year.
Yeah.
But if you look at the per capita income of Bangalore, it will be around 7.5 lakh rupees. If you look at the per capita income of Gurgaon, it will be around 8 to 8.5 lakh rupees. And Hyderabad will be no different. So as income levels have gone up, you are there was an ad, Maruti ad, some 15 years back. The guy goes into the showroom. That guy keeps on explaining the features, and the only question he asks is, "Kitna deti hai?" So what is a mileage? So from a mileage-based buying, say 15 years back, we have moved to a feature-based buying. Now it's some crazy stats. 50% of the new cars sold in the country has sunroof. 25% of the new cars sold in the country has ADAS. Now, I drove a car with ADAS. It's just simply impossible to drive in India with ADAS, because the moment you take 3 seconds off the road, it's going to say take a break, drink coffee, or, in India, you don't stop for pedestrians, right? If you stop for pedestrians, you won't reach your destination. So you have to switch off ADAS. But still people are buying these kind of things. It's a new feature. It's a new thing. You want to enjoy. You want to go on a long drive from Bangalore to Goa and enjoy. So what happens is that if I am an investor allocating capital, so I have to allocate to the guy who's gaining market share. So if within auto, I will choose the SUV and the mini SUV player than the hatchback player. Okay. Similarly, if you look at the wood panel industry, initially there was apprehension about, say, MDF. People are using only plywood, etc. Very similar to pipes. If you look at pipes, say 15, 20 years back, everyone installed only copper pipes. I'm talking about plumbing pipes for buildings, hotels, airports, malls. But now, PVC and CPVC has become very, very normal at this point in time, right?
True.
So what happens is that a similar thing is happening in the wood panel industry. I was in Hyderabad IKEA also. People are buying value for money table, chair, and furniture made out of MDF. It's inexpensive compared to, at least 35% inexpensive compared to a ready-made plywood, 100% plywood based chairs. So a lot of shared workspaces have started using this. So this structural shift from, so how do we look at stocks? So the country is growing at say 10% or 11%. I'm talking about nominal levels, not real levels. So Nifty is a nominal GDP product. So if you buy Nifty, you will get nominal GDP returns. So that's what the history says. 10-11% nominal GDP returns. Nifty has given about 11% CAGR returns, basically. So, but we all know the practical inflation in India is around 10%. Although the official inflation is only 4.5%, that's not really, you know that, right? 10% is the inflation level in India. So if you want to meaningfully beat inflation, you need to make a very, very healthy double-digit return. Which is possible only when you look at sectors that are growing at 1.5 to 2 times GDP. So if GDP is growing at 10%, I have to look at sectors which are growing at 15 to 20%. So if a sector is growing at 15 to 20%, there could be two reasons. One, it's a commoditized reason, commodity supplies, demand is greater than supply, prices have shot up. The other thing is a more powerful structural reason, where people have gotten used to the new thing, they want to buy more of this. So we are seeing that happening in the wood panel industry, we are seeing happening in the ice cream industry. I'll tell you a classic case of ice creams. Ice cream used to be a very urban phenomenon and heavily skewed towards summer months. During summer months, ice cream consumption used to shoot through the roof. Now what is happening is, even during winter, when I was in Ahmedabad last winter, Ahmedabad and Delhi, the ice cream parlors were just simply overcrowded at 10:30, 11 in the night, right? So this is on the urban side. And on the rural side, because of better power availability, the second order impact is that the rural shopkeeper is able to stock a refrigerator, and by virtue of having a freezer, he is able to stock up on the ice cream, and therefore a rural child is also able to enjoy a scoop of ice cream worth 30-40 rupees today. So ice creams are going to see explosive growth, and for a market of 1.4 billion, here we can really say 1.4 billion. 30 rupees ice cream can still be enjoyed by India 3, the lowest in the pyramid, right? So it's hardly a $2 billion market, which is nothing. It is just scratching the surface. Similarly, I also like protein related plays, Naresh. So as more and more awareness is happening about protein, so if you look at the Indian plate, the meal that we eat, it is ridiculously carb heavy. Whether it is South Indian or West Indian or North Indian, there is hardly any protein in the plate. Whereas if you go to a Mediterranean country, for us the carb is the hero of the meal, everything else is on the side. But if you go to a Mediterranean plate, the protein is the hero of the meal, and the carb and the fiber and everything is on the side, basically. So now there is awareness that if I weigh 72 kilos, I have to have 80 grams or 72 grams of protein every day. And if you're a vegetarian or whatever it is not possible with a vegetarian diet to have that much of protein, right? So I see, if you have traveled abroad, you have these yogurts, flavored yogurts that come with 20-gram protein, 25-gram protein, etc. So that is going to also explode. So this culture of buying dairy completely from the shops is about 15-20 years old. Even 20 years back, in South India, we used to make curd at home. I'm sure you agree with me. Yes. Now, there is a second order impact of more and more women participating in the labor force. So there is paucity of time in the kitchen. And therefore, people actually use, quick commerce to buy your curd. So your packaged curd, your GDP is growing at 10%, but packaged curd market is growing at probably 13-14%. Paneer is probably going at 13%. Ice cream is probably going at 17-18%. So dairy as a segment, wood panel as a segment, SUV cars and their ancillaries as a segment, power capex as a segment. I'm still bullish on power capex because you are feeding more and more renewables into the grid. Okay, and the grid is like your body's blood pressure. It has to be 130/80. Neither high nor low is desirable. So as you feed more and more renewables into the grid, and renewables are intermittent, meaning that when the sun doesn't shine, you can't generate solar power. When the wind doesn't blow, you can't generate wind energy. And therefore, you're going to see that the technologies that is required to stabilize the grid, which is your HVDC technology, etc., those are going to see phenomenal growth for the next 10 years or so. So we are positive on those type of sectors. Apart from that, it is very difficult to say that I'm bullish on chemicals, because there are thousands of chemicals, and each one has its own supply demand dynamics. So some specific chemicals I'm definitely bullish on. Certain other things we are waiting and watching. And we are also playing hospitals, rather than pharma as a space, because hospitals is more secular, from that point of view. So these are some of the themes that we like and which we have in our portfolio.
Okay. One more question, again from the audience. So, is all this change is bad and the good days are ahead, or this is transformation stage for Indian economy, and we have to rethink on how we invest?
It's not bad, it's definitely, from we geopolitically we have always maintained a neutral stance. We are never permanent friends or enemies. From that point of view, I think in terms of how we invest, etc., is it's an evolving thing. It keeps on changing. But broadly, it throws up new opportunities. 1995 Nifty 50 components and today's Nifty 50 components, the commonality is only 11 stocks. 39 stocks are not part of Nifty anymore. I mean, when Sensex was initially there, you had a lot of textile companies like Bombay Dyeing, Indian Rayon, and you must remember all those names. Today, we don't have those companies. Today, it has some other leaders have. So the new leaders are below the Nifty. Nifty Next 50, the mid cap. Those are the ones which are going to be the future winners. So essentially, what is happening is companies that have extremely high ROE, ROCE, they are getting attacked, especially if you're low on technology and if people can easily replicate your product. So which is what exactly has happened in the case of Asian Paint. The technology is low, but the strength is on the distribution. So somebody feels that I can be as good in distribution as the leader, so they have invested heavily on the paint segment. Similarly, cable segment, we have seen the entry again of Ultratech Cement into the cable segment again, because the cable companies, the cable stocks were trading at a significantly high. So my gross block, my assets are only 1,000 crores, but if market is giving me 50,000 crores, it attracts competition. So that is exactly what is happening as far as the this industry is concerned. So it is just pure supply demand. We are in interesting times. One thing what history has told us is that the moment you hit a $2,500, $3,000 per capita, you go through a bit of a J curve. So which means that the demand for many of the consumer items, consumer products, it just kind of explodes, right? So what was once a luxury becomes a basic. So we all have children, and you agree that AC for them is like a very basic thing, air conditioners. But for us, it is still a bit of a luxury given our 1980s, that kind of the age profile. So these things are going to propel huge demand in air conditioners, washing machines, where the penetration levels are still not on par with the ASEAN countries. So from that point of view, there's still a long runway and long opportunity. So these kind of pullbacks after 3 years, it might look like a missed opportunity for investors.
Okay. Now, one more. I think this would be the last question. What's your opinion on Web3 related companies and its growth?
Web3 meaning the AI related?
To an extent, yes. It's actually Web3 would be into the entirety of. Also, it steps into the cryptos kind.
So the simple
Web3.
answer is we are playing it via power stocks. It might sound you can either play a theme directly or via proxy. I can play it via proxy if I don't know who the clear winner is going to be. I don't have an answer on whether it's going to be ChatGPT or or which company is going to do what. The answers are not clear. But what is very clear is that the power consumption is going to go through the roof with more and more data centers, with more and more. Today there is a course that you can take for ChatGPT. The kind of prompts that you enter, will give you, it gives you reports in 10, 15 minutes or 30 minutes. What an analyst would probably take 48 hours to do a job, ChatGPT is able to do 80 to 85% of that in 30 minutes time, provided your prompts are very good. So it consumes a lot of power compared to your Google search. So when that happens, and with that power, you are feeding more renewables. So this is a deadly combination. So the power capex has to be very, very, very significant. So we should be having 20% of the data. We produce 20% of the world's data, but how much percentage of data stored in India is not even 2%. So there's going to be a significant investments in data centers, and anything related to that is a better way to play the Web3 story than trying to find out who the winner is going to be. Actual winner is going to be on the Web3 side.
Yeah, just to round off, are there any significant changes in your fund management approach your funds, and with the kind of course you have completely through your thesis you destroyed the thought that whatever the external tariffs could impact. So though we put the as tariff and how it impacts, but which you have actually destroyed that part. And so now I'm just trying to see, is there any changes that you're still trying to make through your thesis or through your existing investments in your portfolios, rather in your investment side? Because I think you didn't mention much about the new age renewables or something on that as a theme.
Nothing wholesale, Naresh. So we, like I said, we are quite constructive on companies like cables. Although competition has come in, there is still a long runway for cable and wire companies, given the growth from commercial and residential and industrial. So we've not even added any kind of. So we added a company called Vimta Labs, which is again a Hyderabad-based company, because we are quite bullish on the testing. Testing anything and everything is going to get tested in India, whether it's a jackfruit or an onion or a pomegranate, whether it's fruits, vegetables, or electronics, mobile phones for their electromagnetic interference, or clinical trials. These are all going to be outside of tariffs. And as the tariff war blows up, you're going to see that the country erecting a lot more non-tariff barriers. Therefore, more and more things are going to get tested, and Vimta is going to be a beneficiary because of that. Otherwise, our usual strategy of trying to locate market share gainers, irrespective of what happens in the macro, Naresh, one thing I'm very positive is, if there are two companies, X and Y, X has a very sorted strategy, sorted management, sorted product mix, sorted distribution strength, and everything. Y used to be a very good legacy brand, but Y, the promoters are warring amongst themselves. The brothers are not coming into some conclusion. There is capital misallocation happening. So if X is gaining market share from Y, X will outperform the market like anything. So I will simply go and buy X irrespective of macro. I'll give you an example. After COVID, there was a huge boom in travel and tourism. If I had taken a top-down view and said that, looks, because travel and tourism is booming, let me go and buy. How do I play travel and tourism? I buy either a hotel company, or I buy an airline company, or I buy a luggage maker, because as you travel more, you need to buy more different types of luggage. So these three segments are going to broadly see a lot of growth. So we zeroed in on luggage, and within luggage, if I had gone and bought the leader, closing my eyes, just on the macro view, saying that tourists within, there is MICE, meetings, conference, entertainment, etc., etc. So if I just gone and bought a leader, which is VIP Industries, I would have not made any money. But we bought the second player, which is Safari Industries, because Safari Industries was actually busy gaining market share from VIP Industries. They were ahead of the curve in e-commerce, in their product mix. VIP had its own set of issues. So you can check the stock price between VIP and Safari. VIP has not at all gained because of this travel boom, but Safari is able to gain significantly because of the travel boom. So we are seeing that situation happening in something like the rating agencies. So we have three companies: CRISIL, ICRA, and CARE. So you can look
Yeah.
at the last 5 quarters of growth. CARE has been the only company that is growing much faster than CRISIL and
Yes.
ICRA. So at some point in time, market will recognize this, and you will see that the re-rating happens for this company. So that our stock picking is always based on that. We keep a close eye on macro, but we don't dictate the macro for our stock calls or stock.
That's a very enchanting. I mean, we have overshot our time, yeah, but nobody complained, and actually, we see some good responses. Thanking you for your the way you have put across. And yeah, it's been more than a decade knowing you, and each time there is a revelation for us. And I think we need to do this much regular. Maybe like familiarity breeds contempt. So maybe just that we know you, we are just taken granted. But I think each interaction is something afresh. I think we will strike with you, especially this. I think sometime very soon we'll drag you again onto this ArthSamvaad meet,
Yeah,
and
yeah, yeah. I mean,
we'll
the pleasure is
interview you
mine.
again.
Pleasure is mine. I congratulate Team Velocity, and I still have the 2022, the event photo on my. Uh, I think it was called Riddhi, if I'm not mistaken.
Yeah, Riddhi.
Yeah,
Yes,
yeah,
yeah,
yeah. 3 year
yeah,
back photo.
yeah, yeah,
So yeah, it's a pleasure interacting with you as always, and hope to see you soon in Hyderabad.
yeah, yeah. Sure, sure. Thank you,
Thank you,
and
Balaji. Thanks for your
thanks. Yeah, thank you from Velocity team, and also I thank Balaji again on behalf of all the attendees. I also thank the attendees who have taken time. Thank you, everyone.